Welcome back to CMA USA Exam Coach, your study companion on the journey to crack the CMA exam. In today's episode, we are starting a new topic under Section C of Part 2, and that is marginal analysis. If you've been following our previous videos, we already covered cost volume profit analysis, or CVP. Now we are moving forward to the next key decision-making tool, marginal analysis. So what exactly is marginal analysis? It's a simple but powerful concept that helps managers take better business decisions. Marginal analysis means looking at the additional benefit or additional cost of doing something extra, like producing one more unit, taking one more order, or spending more on advertising. In short, it answers the question, is it worth it to do a little more? And that little more, we call that the marginal change. Throughout this episode, we'll explore how marginal analysis is used to make decisions like accepting special orders, outsourcing versus in-house production, selling or processing further, and more. Let's begin with the basic concepts first.
Let's now understand the core idea of marginal analysis. Marginal analysis is the process of choosing between two or more alternatives by comparing their additional benefits and additional costs. In business, managers are constantly faced with choices. For example, should we accept a special order? Should we make the part in-house or buy it from outside? Should we discontinue a product line? To make the right decision, management must focus only on what will change as a result of the decision. That means we look at the additional revenues and additional costs that each option will bring. These are called relevant revenues and relevant costs, because only they will affect the outcome of the decision. In marginal analysis, we ignore any cost or revenue that will stay the same, no matter which option we choose. These are called irrelevant costs, and we'll talk more about them later. So remember the key point. Marginal analysis is not about total costs or total revenues. It's about the difference between alternatives. The option that gives the highest net benefit, that is, the highest additional profit, is the one we choose. Before we move forward, let's take a moment to list some of the key cost concepts that we will use repeatedly in marginal analysis. Understanding these costs clearly is very important because they help us decide which information is relevant and which is not in each decision-making situation. So, here are the main cost types you need to remember. Relevant cost. These are the future costs that will change depending on which option you choose. Only these are considered in decision-making. Avoidable cost. These are the costs that can be avoided if you select a particular alternative. If you make a different choice, these costs won't continue. Sunk cost. These are past costs that have already been spent and cannot be recovered. They are always irrelevant in decision-making. Opportunity cost. This is the potential benefit or income that you give up when you choose one alternative over another. It's not recorded in books, but it's very relevant in analysis. In the next few slides, we'll dive deeper into each of these with examples and real decision scenarios. Let's continue. Let's now understand what we mean by relevant costs in marginal analysis. Relevant costs are the costs that differ between alternatives. In other words, they are the additional or avoidable costs that will be directly affected by the decision you make. If a cost stays the same, no matter which option you choose, then it is not relevant. Only the costs that change depending on the choice you make should be included in the analysis. Let's look at a simple example. Suppose a company is deciding whether to accept a special order from a new customer. To fulfill this order, they will need to buy extra raw materials for $5,000, hire temporary labor for $3,000, and there will be no change to fixed costs like rent or salaries. In this case, the raw materials and temporary labor are relevant costs because they will only be incurred if the company accepts the special order. But the fixed costs like rent or regular staff salaries are not relevant because they will be paid anyway, whether or not the order is accepted. So, the decision should be based only on the costs that change, that is, the relevant costs. Also, keep in mind, some decisions may include special one-time costs, like extra shipping charges or setup costs for a new job. These are also considered relevant because they apply only to that specific project or decision. To summarize, relevant costs equals future costs that will differ based on the decision. And these are the only costs that should be included in marginal analysis. Now let's talk about avoidable costs. Avoidable costs are the costs that a company can completely eliminate if it chooses a specific alternative. These costs only exist if a certain option is chosen, and they disappear if another option is selected. So, they are highly relevant in decision-making because they directly affect the final outcome. Here's a simple example to understand this better. Imagine a company is thinking about closing one of its product lines. This product line currently has the following costs: direct materials and labor, $10,000, special advertising, $2,000, factory rent, shared with other products, $5,000. Now, if the company discontinues the product line, the direct materials and labor will stop. These are avoidable costs. The special advertising for this product will also stop, so this is avoidable too. But the factory rent will continue because the space is shared with other products. So this is a non-avoidable cost in this case. So what do we conclude? Only the costs that will stop completely if the decision is made. Those are the avoidable costs. And in marginal analysis, we consider only these avoidable costs when comparing options. If a cost will still be incurred, even after choosing an alternative, then it is unavoidable, and we ignore it for decision purposes. Let's now understand an important concept in marginal analysis: sunk costs. A sunk cost is a cost for which the money has already been spent and cannot be recovered, no matter what decision you take now. Since this cost has already happened in the past, and you can't change it or get it back, it becomes irrelevant in decision-making. In other words, sunk costs are unavoidable, and therefore, we should ignore them when comparing alternatives. Let's take an example. Suppose your company spent $50,000 last year to develop a new software product. Now, after development, you are deciding whether to launch the product or drop the project. The $50,000 already spent is a sunk cost. Whether you launch the product or cancel it, that money is already gone. It won't come back. So, when making your decision, you should not let that sunk cost affect your judgment. What you should focus on instead are the future revenues and future costs, things that will actually change depending on your decision. But in real life, many people struggle with sunk costs emotionally. They think, "We already spent so much, let's continue anyway." This is called the sunk cost fallacy, and it often leads to poor decisions. So always remember, in marginal analysis, sunk costs are irrelevant. Good managers learn to ignore them and make decisions based on future benefits versus future costs only. Now let's understand another important concept in marginal analysis: opportunity cost. Opportunity cost is the potential benefit or earnings that you give up when you choose one alternative over another. In other words, it's the income or value you miss out on because you decided to go with a different option. Opportunity cost is not recorded in the accounting books, but it is still very relevant in decision-making because it represents a real economic sacrifice. Let's take an example. Imagine your factory has 1,000 machine hours available this month. You are currently using that time to manufacture product A, which gives a profit of $10,000. Now, a new customer offers you a contract to make product B using the same 1,000 machine hours, and product B would give you a profit of $14,000. If you accept the new contract, you will have to stop producing product A. So, the opportunity cost of choosing product B is the $10,000 profit you would have earned from product A. Even though you're not paying $10,000 in cash, you're still giving up that benefit. So, in your decision analysis, you must consider this opportunity cost. To summarize, opportunity cost equals the benefit of the next best alternative that you give up. It is not a recorded cost, but it is very real and relevant. It helps managers make better decisions by considering the full economic impact. Now that we understand the key cost concepts, Let's see where we actually apply marginal analysis in real business decisions. For the CMA USA exam, there are 5 major decision-making areas where marginal analysis is used. These are practical, real-world situations that every manager may face. Let's list them out. 1. Sell or further process. This decision comes up when a product can either be sold in its current form or processed further to make a more finished version. We use marginal analysis to decide whether the extra processing is worth the extra cost. 2. Accept or reject a special order. Sometimes companies receive special orders at a lower price than usual. Marginal analysis helps decide whether accepting the order will still add to the company's profit, even if the price is below normal. 3. Make or buy. This decision is about whether to produce a component in-house or to outsource it from a supplier. We compare the relevant costs of both options using marginal analysis. 4. Keep or drop a segment. Here, the company decides whether to continue or discontinue a product line, department, or business segment. Marginal analysis helps determine if dropping the segment will increase or reduce overall profit. 5. Maximizing contribution margin per limiting factor. When resources are limited, like machine hours or labor hours, we use marginal analysis to decide how to use those resources in the most profitable way. The goal is to maximize the total contribution margin. In the next slides, we'll go through each of these 5 applications one by one, with clear examples and explanations. So let's begin with the first one, sell or further process decision. Let's begin with the first application of marginal analysis, sell or further process. This type of decision arises when a company produces a product that can be either sold at a certain stage of completion or processed further to create a more finished product that might be sold at a higher price. To put it simply, sometimes the product we manufacture can be sold as it is, without doing anything extra. But in other cases, we might have the option to do additional work on it, called further processing, which can turn it into a more valuable product. For example, think about a dairy company that produces raw milk. They can sell the milk directly to the market, but they also have the option to further process the milk into cheese or butter, which usually sells for a higher price. Now, the key question is it worth spending additional cost and time to process it further? Or is it better to sell the product right now and avoid the extra cost? To answer this, we compare the incremental revenue from selling the further processed product against the incremental cost of further processing. If the additional revenue is greater than the additional cost, then we should go ahead and process it further. But if the extra cost is more than the extra revenue, it's better to sell it as is. So, this decision is based on relevant costs and relevant revenues, exactly what marginal analysis is all about. Before we jump into the calculations, let's take a moment to understand some of the important cost terms involved in this type of decision. These costs help us figure out whether it makes sense to sell the product now or process it further. First, joint cost. Joint costs are the costs that are incurred up to the split-off point. In simple terms, it's the total cost we spend to produce multiple products together, before they are separated into individual products. For example, in a petroleum refinery, crude oil is processed, and as a result, you get multiple outputs like gasoline, diesel, kerosene, and so on. The cost spent until this stage, where all products are still mixed, is called the joint cost. It's important to remember, joint costs are not relevant when deciding whether to sell or further process. That's because joint costs are already incurred, regardless of what decision you make. So they are sunk at this point. Second split-off point. The split-off point is the stage in production where the joint products become separately identifiable. It's like a branching point. After this, you can choose to either sell the product in its current form or spend more to convert it into a new form. So basically, this is the decision point in the process. 3. Further processing cost, also called separable cost. These are the additional costs incurred after the split-off point to turn the product into a more finished or higher value version. Since this cost happens only if you decide to process further, it becomes a relevant cost in the decision. If you decide to sell the product as is, you can avoid this cost entirely. So, these costs are not sunk. They're future, avoidable, and relevant. Exactly the type of costs marginal analysis focuses on. Let's now understand this concept with a real-world example that makes it easy to visualize. In the slide, you can see that our main input is crude oil. Crude oil goes through a production process where it is heated, separated, and refined. During this process, we incur a common cost that is shared among all the outputs. This shared cost is what we call the joint cost. Now, at a certain stage in the refining process, we reach what's known as the split-off point. This is the point where the crude oil breaks down into separate, identifiable products, such as petrol, diesel, and kerosene. From this point forward, each product can either be sold as it is, in its basic form, or further processed into a more valuable version. Let's take petrol as an example. At the split-off point, we get regular petrol, and we can sell it directly in the market. But there's also an option to spend additional money on it, through blending, chemical treatment, or additives, to convert it into premium petrol, which sells at a higher price. So, what is our decision here? We need to check, will the extra money we make by selling premium petrol be more than the extra cost we have to spend on processing it further? If yes, then further processing is worth it. If not, it's better to sell the regular petrol as it is. And remember, the joint cost is already incurred, whether we sell it or process further. So it's not part of the decision. Only the additional cost after the split-off point and the additional benefit from selling the upgraded product matter in this decision. We'll go through the actual numbers in the next slide to show how this decision works step by step. Let's now understand the full concept with a practical example. We have a company that processes raw material X into two joint products, Product A and Product B. For every 100 units of raw material X, we get 60 units of Product A and 40 units of Product B. That means the product mix is 60% for A, 40% for B. Now, the company is currently processing 1,200 units of raw material X. Let's first calculate how much of Product B we are going to get. 40% of 1,200 equals 480 units of Product B. Now the company has two options. Sell Product B as it is, at the split-off point, for $12 per unit, or further process it, which costs $3,360 in total, and then sell it for $20 per unit. So let's compare both scenarios. Option 1. Sell at split-off point. If we sell the 480 units directly, revenue equals 480 times 12 equals $5,760. Option 2. Further process and sell at higher price. After processing, 480 units will sell for $20 each. Revenue equals 480 times 20 equals $9,600. But we have to spend $3,360 to do the further processing. Now let's calculate the incremental benefit of further processing. Revenue after further processing equals $9,600. Less. Further processing cost equals $3,360. Net benefit equals $6,240. This incremental revenue of $6,240 is higher than the $5,760 we would get by selling at the split-off point. So clearly, further processing gives us more profit. Final answer: sell Product B after further processing because the additional benefit is greater than the additional cost. And remember, the joint cost of raw material X is not part of this decision. It's already incurred. So we ignore it while deciding between the two options. Before you try solving questions on your own, let's understand this in the simplest way possible. Imagine this scenario. I have a product that cost me $1,000 to produce. Now I have two choices. Option 1. Sell as is. I can sell it right now for $1,200. So my profit will be 1,200 minus 1,000 equals $200 profit. Option 2, further process. Or I can spend an additional $300 on further processing the product. That means my total cost will now be 1,000 plus 300 equals $1,300. After further processing, I can sell the product for $1,700. So what's my profit now? 1,700 minus 1,300 equals $400 profit. So when I sell it without processing, my profit is $200. But when I further process it, my profit becomes $400. That means by spending an extra $300, I'm making an extra $200 in profit. So clearly, further processing is the better decision in this case. This is exactly how marginal analysis works. We compare the additional revenue with the additional cost, and if the benefit is higher, we go for it. Let's now summarize the whole idea of further processing using a simple decision rule. In the slide, you can see two possible comparisons. Case 1. Incremental revenue greater than incremental cost. In this case, the extra money you make from selling the further processed product is more than the extra cost you spend. That means it's profitable to process the product further. So the right decision is further process. Case 2. Incremental revenue less than incremental cost. Here, the extra money you make from the processed product is less than the additional cost. That means you're losing money by spending more than you gain. So in this case, the better decision is sell at the split-off point. And remember, we're only looking at the differences after the split-off point. The joint cost is not part of this decision. It's already incurred, so it doesn't affect the comparison. This simple comparison between incremental revenue and incremental cost is the heart of marginal analysis in this type of decision. Now let's move to the second application of marginal analysis: accept or reject a special order. This decision arises when a company receives an order for its product at a price lower than its usual selling price, often from a new customer or a different market. This type of order is usually a one-time deal, and the company must evaluate whether accepting this order will increase its overall profit, even if the price is below the regular market rate. So, how do we decide? The key rule in marginal analysis is only relevant costs and revenues should be considered. This means we focus on the additional or incremental costs and additional revenue generated from accepting the special order. If the incremental revenue from the special order is greater than the incremental cost, then it will increase profit, and the special order should be accepted. But keep in mind, fixed costs are usually not relevant here, because they are already incurred regardless of the order. Also, the company should have spare or unused capacity to handle the order without affecting regular customers. Let's see a simple example. Imagine your company normally sells a product for $100 per unit. You are currently operating at 80% of your capacity, so you have room to produce more. Now, a foreign customer offers to buy 1,000 units at $70 per unit, much lower than your usual price. Your variable cost per unit is $60, and your fixed costs are already covered by your regular sales. So let's calculate. Selling price for special order, $70. Less variable cost, $60. That gives you a contribution margin of $10 per unit. Since you're making $10 per unit and the fixed costs are not increasing, you will earn an additional profit of $10,000 by accepting the special order. So, in this case, you should accept the order because it increases total profit without affecting regular sales. Now let's understand an important consideration when evaluating special orders. Does the company have excess capacity or not? This makes a big difference in how we calculate the minimum selling price for the special order. A. Excess capacity. This means the company has unused resources, like extra machine hours or labor hours, and it can accept the special order without affecting its normal production. In this case, the minimum selling price for the special order should be variable cost plus any additional cost. Since fixed costs are already covered and no regular sales are lost, The company only needs to cover incremental costs. Let's say variable cost per unit equals $50. There's no additional cost. So even if the customer pays just $51, the company is making $1 profit per unit, and it can accept the order. B. Full capacity. In this case, the company is already producing at 100% capacity. So to accept the special order, the company would have to give up some regular sales. That means, by taking the special order, it's losing contribution margin from existing customers. So here, the minimum selling price must cover variable cost plus lost contribution margin from regular sales. Let's take an example. Variable cost per unit equals $50. Regular selling price equals $80. Regular contribution margin equals 80 minus 50 equals $30. So if the company accepts a special order, it loses $30 per unit in contribution from its regular product line. That means, for the special order to make sense, the customer must pay at least 50 plus 30 equals $80 per unit. If the special order offers anything less than 80, the company would be better off continuing with regular sales. So, remember, with excess capacity, focus only on variable and additional costs. With full capacity, also include the opportunity cost of lost regular contribution margin. Let's now apply everything we've learned with a practical example involving a special order decision. A company has a total production capacity of 10,000 units. They normally sell their product at a price of $120 per unit. The variable cost per unit is $80. Fixed costs for the company are $200,000, and they are already covered by regular operations. Now, the company receives a special order from a customer who is offering to buy 1,000 units at a price of $115 per unit. Our task is to analyze whether the company should accept or reject this order in 3 different situations. Let's look at the first scenario. In the first case, the company is currently producing only 8,000 units. This means they are working below capacity. Their total capacity is 10,000, and they are using only 8,000. So they have an extra 2,000 units available. The special order is for 1,000 units, which means they can easily fulfill it without disturbing their regular production. This is a case of excess capacity. In such a case, we calculate the minimum selling price as the variable cost plus any additional cost. But here, there's no additional cost mentioned. The variable cost is $80, so the minimum acceptable price is also $80. Since the special order is offering $115 per unit, which is well above the minimum price, the company should accept the order. It will generate an extra profit of $35 per unit, without affecting normal operations. Now let's move to the second case. Here, the company is still producing 8,000 units, so they still have excess capacity. But now we are told there is an additional cost of $30,000 that must be incurred to fulfill the special order. So, in this case, the company needs to recover not only the variable cost, but also this additional cost. To calculate the minimum price, we divide the additional cost by the number of special order units. 30,000 divided by 1,000 units gives us $30 per unit. When we add that to the variable cost of $80, we get a minimum price of $110. The customer is offering $115, which is still higher than the minimum price. So, even after covering the extra cost, the company will earn $5 profit per unit. Therefore, the decision here is also to accept the order. Finally, let's look at the third case. In this scenario, the company is already producing 10,000 units, which means it is operating at full capacity. To accept the special order, the company would have to reduce its regular sales by 1,000 units. This means they will lose the contribution margin they would have earned from their regular customers. The contribution margin from regular sales is calculated by subtracting the variable cost from the selling price. So, $120 minus $80 gives us $40 per unit. To make the special order worthwhile, the company needs to recover both the variable cost and the lost contribution margin. That is, 80 plus 40, which gives us a minimum required price of $120. But the special order is offering only $115 per unit, which is $5 less than what the company needs to stay at the same profit level. In this case, the company should reject the order because accepting it would reduce their overall profit. To summarize, in the first case, the company should accept the order because it has excess capacity and the offer price is profitable. In the second case, even with the additional cost, the special order still provides a net profit, so it should be accepted. But in the third case, since the company is already at full capacity and would lose profit from regular sales, the order should be rejected. This example clearly shows how the capacity situation and additional costs impact special order decisions. In the next slide, we'll go through a quick summary of these decision rules. What if the company is currently working at 9,500 units? Remember, the total production capacity is 10,000 units. So, if they are already producing 9,500 units, that means they only have 500 units of excess capacity available. But the special order is for 1,000 units, which means they can only fulfill part of the order using the spare capacity. For the remaining 500 units, they would have to cut into regular production. This scenario is a mixed capacity situation, where part of the order can be fulfilled using excess capacity, and the rest requires sacrificing regular sales. So we need to apply two different cost logics. Let's break it down. For the first 500 units, there's no need to reduce regular production. So the minimum price for these 500 units would just be the variable cost, which is $80 per unit. But for the next 500 units, the company will need to cancel regular sales. That means they will lose a contribution margin of $40 per unit, because regular selling price is $120 and variable cost is $80, so contribution margin is $40. So for these 500 units, the minimum price becomes the variable cost plus lost contribution margin, 80 plus 40, which gives us $120 per unit. Now let's calculate the average minimum price to cover both types of units. For the 1,000 units, 1,000 times 80 equals 80,000. For the lost contribution 500 units, 500 times 40 equals 20,000. So the minimum selling price equals 20,000 plus 80,000 equals 100,000. Divide that by the total 1,000 units, and we get an average minimum price of $100 per unit. So in this mixed capacity scenario, the company should not accept any price below $100 per unit for the special order. If the customer is willing to pay $100 or more, then the company can go ahead. If the offer is lower, it will lead to a loss in overall profit. So finally, the answer is, the minimum selling price should be $100 per unit and accept the order.
So far in marginal analysis, we've covered 2 out of the 5 important applications: sell or further process, and accept or reject special order. The remaining 3, make or buy, keep or drop a segment, and maximizing contribution margin under limiting factors, will be discussed in the upcoming episodes. Now, we've seen that many students are requesting more problem-solving examples, and we understand how helpful that can be. In this episode, we've focused on simple questions to help you understand the concept clearly. If we try to include more problems right now, the video length will become too long and difficult to follow in one sitting. So, here's the plan. Once we finish uploading all the episodes covering the key decision models under marginal analysis, we'll start a separate problem-solving series with full focus on different types of exam-oriented questions. In that series, we'll go deeper into solving various CMA-style problems step by step. Until then, keep practicing. Open your textbooks, try solving problems on your own, and make proper notes while watching these lessons. That will help you retain the logic and approach for each situation. All right, that's it for today's session. See you in the next episode.